Good afternoon and welcome everyone to today's US market update and our Bulls versus Bears presentation. Great to see so many on today's webcast. My name is Kelly May, Associate Portfolio Manager, and here with me today are Fortrend CEO Joe Forster, along with Portfolio Managers Stephen Lyle, Chris Wallerman, and Andrew Corcoran. We welcome question and answers throughout the presentation. Please feel free to click on the question and answers tab at the bottom of your screen to ask a question. We will do our best to answer it in a timely manner and as best as we can. With that, I'll now turn the presentation over to Joe.
Thank you, Kelly. It's hard doing this through webcast because when you're here and I'm getting challenged on issues by people in the room who are much more experienced in your areas of expertise than I am, it adds to the conversation and to the investment club, as I sometimes think of it. So we look forward to getting you back into the office and getting better participation and hard questions. But today, Kelly will monitor the questions as they come through. Of course, we're seeing you soon. It doesn't seem so long ago that we had a presentation because only 3 weeks ago we did the annual earnings results. So we delayed that from typically doing it right at the end of the month to a week later so that we had more annual earnings results out. But now we're looking at and those are what we call the bottom-up analysis, where we look at individual companies and how they're pricing, volume, and accounting for costs and doing foreign exchange, et cetera, on a bottom-up analysis to today's analysis, which is top-down. Top-down is where we are macroeconomic views, where we look at government statistics and overviews, including exchange rates and top-down data. So today is the Bulls versus the Bears. The market, Kelly, do I have control here? Any questions? Right. So the market did fall 2% this 3-week period, while earnings estimates were increased by the relative value model went up by 0.4%, so we outperformed nicely this month, thanks largely to, as I say, your input, led by Viacom CBS, which is on a roll, and we did make an investment in the reflation trade in Exxon, and it surged on us right after we bought it. We got a dividend out of it, and so we took a profit in that, and we invested the proceeds into Amgen. The earnings estimates for 2021 for the current year are up by 0.3%, taking the price earnings, or the PE21, the price earnings ratio, down below 20. So 20 is reflective of a very low yield on the 10-year Treasury, but there was a surge in the 10-year Treasury this month as there was a recovery in the economy, and some people started to expect an increase in economic activity, which could result in inflation. So we saw some increases in commodity prices along with the increases in stocks. But there was some concerns that when you have an increase in the Treasury yield or you have an increase in fixed income yields, that makes growth stocks less attractive. So the FANGs were off this month, whereas the cyclical stocks are jumping. The rotation, the reflation rotation, where we're seeing a lot of strength after COVID in the stay-at-home stocks, such as the FANGs or Zoom or other companies that are helping people to work remotely, those stocks have been doing very well. And now the expectation is that the cyclical stocks that had not participated will now participate. So those are going to be things like cruise lines, entertainment, and hotels, etc., travel, airlines. We did sell Exxon during the month, and we're buying Amgen. we've had a good trade in Amgen. We bought it, it went up significantly, we sold it, and it came down after we sold it, so we're getting back into Amgen. So normally we have a pretty stable long-term buy and hold portfolio, but if we're going to get 20% in a month, we'll take the profit. And so that's what we did with Amgen, and it fell back down, so we're buying back into it. The biggest movers in the market, you can see here the increase in price. Marathon Oil up 40%. Goodyear Tire. I mean, these are companies that you would normally not see this kind of move out of, but you see there's oil company Marathon, then dropped down to Apache and Devon, and then Occidental and BP and Conoco. So big drive by oil. We participated in that. We got out. Also on the upside, there's a recovery in Carnival, United Airlines, and so we're seeing some of these travel stocks, but I think we could potentially see more upside in airlines and cruises, but they have such giant balance sheets. If they can't get their marginal costs covered, they're not going to be able to cover any of their fixed costs. So what we need to see is some real increase in volumes, and I can't see international flights, and I can't see Carnival and Royal Caribbean really getting back to capacity on their flights, particularly the international routes. The U.S. might be opening up, and Texas today said that they're just opened up completely. We're just not going to see the same thing happen if somebody wants to, for example, get on a cruise and pass through Australia. It's just not going to happen. Australia remains very closed, as do many other places, and a lot of people are afraid of getting sick. On the downside of the market, Tesla, you know, we've seen some of the FANG stocks plus Tesla, some of the other growth stocks come down. But the big one that the big ones there are going to be Alibaba, Apple, and Tesla. We've also seen weakness, less so in Google, the stock we own it, that was down about 4%. So it had held up nicely, but other stocks in that sector are also down. I think it's really interesting. One stock here that I want to draw your attention to is Anheuser. And Anheuser is a Dutch company that is the largest beer company in the world. So where we've invested in Coke, that has half of their earnings in the US and half of their earnings from direct to consumer and half through events like concerts or restaurants. It's similar with Anheuser-Busch, which makes Budweiser, and that a couple of Australian brands in there that you probably know. They own Foster's and Cascade. So there are 100 different brands around the world, biggest beer company. And when I was young at college, people used to go, or even here, people come over to watch the NFL football game and have a few beers at my house. That's just not happening anymore. So when we start to open up and people start visiting friends or going to restaurants or going to events, companies like Anheuser-Busch could benefit significantly. So it's something we're keeping an eye on, down 12% this month. Andrew, do you want to comment on any of those stocks, or does anyone want to make a comment on any of these major movers here? Do we have any questions? Anything that would you guys like to comment on one of those stocks? Steve, Chris?
Nothing to add.
Nothing to add? No? Kelly?
No.
Nope. Okay, so, well, we should mention Viatris is down. We'll go into that in more detail. We've had one stock that's underperformed this month, but we've had a bunch of them that outperformed. So overall, we outperformed the market, which is good. The top-down analysis, and the point I want to get across very clearly is that collective learning is accelerating at a very rapid pace. Now, collective learning is the ability to have the internet and share information from one side of the world to the other side of the world, and then have access to things that people have researched and have a vetting process. And so what we're seeing is that the knowledge base of humanity is increasing at what they call an ice hockey stick rate. So it's just really accelerating very fast. And it's very exciting in terms of what the prospects are for humanity. The major areas of this accelerated learning are coming in as my favorite area, the blockchain, but also in artificial intelligence and in CRISPR, which is a palindromic repetitive gene splicing, basically. So what you could do, I could have a gene spliced into me and change my eyes brown, and then they would go through to my offspring. So this gene splicing technology is changing very, very fast. And whether there are ethical issues or not in there, there are a lot of very, very rapid advances in artificial intelligence, blockchain, and CRISPR. And that is radically changing the world. There's a woman I met in New York named Kathy Wood. When I was developing my blockchain business, Domus, we pitched that to this woman, Kathy Wood. Very nice, down-to-earth person who can really listen and understand. I got a lot of respect for her. She runs something called the Ark Innovation Fund, which is known to be, the poster child for its investment in Tesla, and her continued radical support, considered by many radical support for Bitcoin, for Tesla, but other companies, Roku, Teladoc, Baidu, Zillow, Shopify, CRISPR Therapeutics. I would encourage you to speak to the staff here, to the people here, and get a list of what the Ark Innovation Fund owns. Kathy is suddenly become a rock star in Wall Street with the success of her Ark Innovation Fund, but this stuff is radically changing the world. And I'd encourage you to follow Kathy Wood, the Ark Innovation Fund, and some of the stocks she owns. And of course, the United States has the highest velocity of creative destruction. I mean, they are really tearing down and ripping and replacing industries that are not necessarily that old and are very nimble and able to do things. And I think that's clearly evidenced by the speed with which new vaccines were developed to fight this COVID virus. Very impressive. And that is just mostly because the U.S. has the best political platform in the world. So it's the political platform that is allowing for these things to happen. So it's an extremely impressive political platform that allows the United States to develop these things. That's the big picture bullish scenario. What I want to focus on, though, in the shorter term is that there are four things that move markets. And the first thing that moves markets, of course, is earnings. When earnings go up, stock prices go up. And when earnings go down, stock prices go down. So that's the first thing that factors into the valuations. The second thing is interest rates. And when interest rates go up, price-earnings ratios come down and vice versa. And there's an envelope of sensitivity where stock prices are sensitive to interest rates. But if interest rates went to 10%, as they were in the 70s, then you'd expect price-earnings ratios to fall to about 10 times forecasted earnings. And I'll have Chris explain that in a little more detail in a little bit on the envelope of sensitivity. The third thing that moves stocks is risk. And when earnings stream is a higher risk, then you're going to pay less for it. If the earnings stream is stable, you're going to pay more for it. So there's a bell curve around the earnings estimates for any company or industry or grouping. So what we'll see is that as risk increases, prices fall. When risk falls, prices go up. So people pay less if you're taking risk. And the fourth thing that really moves markets is liquidity. If you have a stock that has a $100 billion market cap, and it has a lot of bankers following it and trading it, it's worth a lot more than, let's say, an Australian micro cap $25 million stock, because you can get out. And if you can get in and out of a stock, there's value in the liquidity. Now, the liquidity issue, not on a bottom-up micro analysis, company by company analysis, applies also to quantitative easing, where the Federal Reserve is buying illiquid assets from banks. So what happens in quantitative easing is that the Federal Reserve will go to a bank and buy an illiquid asset, and then the bank will have cash that it can lend out, creating liquidity in the marketplace. So I want to go through where we are with these four things that move markets, and try and get a sense for whether we think the market is over or undervalued in the shorter term, as opposed to our longer term view where the, oh, we have a question. Good. We got a question there, Kelly? So who is that?
Jordan.
Jordan, curious about your statements about the U.S. having a platform as China, India, Europe all developed vaccines faster than the U.S. China is strictly ahead, but in AI and digital currencies. China has no political hindrance. Okay, I understand your view, Jordan, that China has an enforced enforced harmony, and that it's well, let me take a bigger step back. Rome was like China in that it was run by a single political party. And a single political party can direct and cause things to happen more efficiently than two parties where you have opposing ideas. Now, the question becomes, which is sustainable? Okay, so yes, there are arguments that a single party political system gives the ability to the government to run things by direction, but I think a two-party system has shown that the US has got an advantage over many of these things. Now, there's a lot of stuff happening in China, as you say, such as artificial intelligence. I think what comes to my mind, not digital currency, but what comes to my mind primarily is the quantum computing. And, you know, it's on the back of US work. So China's going through a stage where they're playing catch up with a whole bunch of stuff going on in the rest of the world. The question becomes, are they going to go from imitators to innovators? And whether they make that transition is to be seen, but I still think that the US is a better system. Honest?
Yes, well, I think that the mix in the US of a very broad and deep university research culture mixed with an accommodative government regulatory environment, mixed with free markets and individual entrepreneurship, creates an incredibly powerful overall economy for the US. And it's more diversified, you might say, than China, which is really run by a single party. So if that party gets it wrong, while they can push something through quickly now, it's not necessarily going to lead to the best outcomes. Sometimes compromise and debate is better than a single authoritarian government.
Now, we're not placing all our bets on the United States. You know, clearly the world is being split in half. It's East versus West. China is building its roads and belts and roads through Africa and other countries that the U.S. would not deal with because they have dictators and they don't have anti-corruption policies that are the standard of the U.S. China's pushing through Burma and Pakistan, and so I think that China has a lot going for it in terms of its ability to take over its half of the world. There are very big lines being drawn. Trump really identified and tried to hold China back. Biden's going to be a pushover. We'll do very little about it. But we do have a bet on China too, and we've invested in the bats, and we still have Alibaba, and we still have Baidu, and but we're at the moment out of Tencent. But I think that there's a good case for China too, and having investments there. But I think the U.S. is a better system by far. Strategists are promoting cyclicals, so there's a big push by strategists to promote these cyclicals on further expansion of the economy, but I think there's potentially some faults in those arguments. One of those potential faults is that Trump cut taxes for corporations to 21%. And when he cut the taxes, it increased the profit margins for US companies. And those profit margins stayed high. And that was surprising to us. We expected that when you have profits there, other competitors will come into the marketplace and eat away at those profits and bring them down back to a competitive level. And that didn't happen. And one of the reasons that didn't happen is that for the last 30 years, antitrust rules in the US or laws in the US have been easy. So we now have largely an unofficial three-company leadership policy. If you look at consumer products, or you look at U.S. telecom, or you look at entertainment, you often have just 3 leaders these days. And so fewer competitors means that the 3 can maintain their margins. Of course, that's offset by globalization, where you might think that the U.S. now has to compete with China or Europe. But the U.S. antitrust policy has been easy, and that, I think, has resulted in these margins staying high for the last cycle, which is partially offset by globalization. And so I think there's some risk that the companies that have been the most profitable and seen these margins expand could potentially be vulnerable. Okay. Now, there are some signs that technology has become too powerful, and there is some risk that there could be pushback, regulatory or government risk pushback on big tech. And I'm going to mention 3 incidences that are, I think, demonstrable of this potential risk. One, China is reining in Alibaba. So we haven't heard from Jack Ma except for once in the last 3 months. He came to a conference in Hong Kong, spoke out against the regulators, and he's disappeared. Now, if I were Chinese and I was running a business in China, I would be now very careful about what I do. Whereas I think in the United States, people can go ahead and do these things without fear of disappearing. So one of the reasons I think the US is a better system than China, you have more clarity on and human rights. And I think that's going to last. So there is a risk in China that there's some reining in. Elizabeth Warren ran for president, and of course she was promoting the idea of breaking up big tech. Now she's in the Senate, and she is pushing, and she will continue to push, and it will become part of the Biden administration. Now, without going too much into politics, Biden's old. He is already sometimes needs some training watching teleprompters, and it scares me that a San Francisco-based, San Francisco is notoriously socialistic, California is. So to have Kamala Harris, if she becomes president, we have a San Francisco-based prosecutor in the White House. It concerns me. So, but I do see a swell of politicians that are afraid of Facebook and Google and will try to rein in what they're allowed to publish. And then even though, and I don't want to be offensive to Australia here, but Australia is not that significant, but their policy against Facebook and Google could be an indicator of a platform or a way of dealing with content providers that could be adopted by other countries. So of course, Scott Morrison came out and said, we got a new law. Google and Facebook are going to have to pay the content providers. They're going to have to pay news agents, news writers, story writers. And I just think it's wrong. I just think that that whole idea was wrong. Facebook, of course, pulled their content, and then they did a deal. And Morrison came out and said how great his deal was, but I don't think it was. I mean, it sounds like politics to me. But the issue here is that there's regulation, a standard of regulation, or potentially a what do you call it, a roadmap or a way that could potentially
A blueprint.
A blueprint. That's the word I was looking for. Yeah, a blueprint on what others could adopt. And if Australia had got what they were looking for, then Google and Facebook were in fear that others would adopt a similar approach. I frankly think that these news agents should be, these writers like News Corp should be able to just password protect their work and give a teaser. And they should be responsible by market forces to go out and figure it out. And that Facebook and Google, if they want to not have their stuff posted on Facebook and Google, they won't do it. So I'm just more of a free markets person. So I think there is some argument that big tech is too big for its own good, and there could be some government pushback. Remember in January last year, we talked about Google and Facebook and the FANGs becoming 20% of the S&P 500, then went all the way to 25%. So there could be some headwinds for that. Now, this is in the wrong thing, but here, earnings go up. You see prices go up. Interest rates I'm going to go down. When interest rates go up, price earnings ratios come down. So I want to show you how this affects the relative value model chart. So when interest rates go up, it'll push the slope down. Now that slope is the price over sales divided by return on sales, and it's showing the price earnings ratio. So that price earnings, the slope of that price earnings ratio will come down as interest rates go up within the envelope of sensitivity. So let me let Chris talk a little bit about interest rates and the envelope of sensitivity. Do you mind doing this slide, Chris?
Yeah, sure. Yeah, so perhaps we could highlight that there's really a channel within which the that inverse relationship between interest rates and PE ratios holds, and it's probably around the 5 to 10% 10-year bond yield range, where a 5% 10-year bond yield would be equivalent to a PE ratio of 20, and a 10% 10-year bond yield would command a PE of 10 times earnings. And that would be sort of in balance as these two alternative asset classes are competing for investor funds. Now, a difference, some differences to point out are that you have very low risk associated with a bond, and with stocks you have growth over time. So that growth comes with some risk, and you have a guaranteed return of capital with the bond. We are well outside the envelope of sensitivity at the moment, with the 10-year bond yield finishing the month at about 1.4%, rising dramatically. It's hard to imagine that we're talking about 10-year bond yield at 1%, 1.4, and having risen dramatically. But the slight sell-off that we experienced that has been somewhat attributed to the rising bond rate, we feel is reminiscent of the taper tantrum that we saw in 2015 when the Fed and other central banks were discussing the withdrawal of the ultra easy, unconventional, really emergency policy measures. And whilst we've seen this sort of taper tantrum or reaction to rising bond yields being a short-term impact to stocks, it really hasn't carried over the longer term. And in fact, we've seen them move in sync in some periods. And I think that it's important to focus on the positive aspect of the withdrawal of these emergency policy measures, because they're not intended to remain in place indefinitely, and they're actually an endorsement that the economy is improving, and of course stocks and businesses will participate in that improving economy. So there's a bit of push and pull there, but in sum, we're well outside the envelope of sensitivity, so we don't foresee bond yields normalising or rising, becoming a headwind for price earnings ratios. Yep.
So the market overreacted by selling into this rising interest rate environment because we're outside the envelope. And the third thing, of course, is risk. Now, we've seen a substantial reduction in risks with the election now done, with COVID looking like it's under control with the vaccines going out. And the third risk is U.S. fiscal and policy. So what we're seeing going forward, I think fiscal policy and an increase in debt is still a risk. The Fed has more debt than corporations or consumers, corporations have a lot of cash. Consumers don't have a lot of debt. Biden putting 1.9 trillion, it says it'd be the trillion on top of existing debt is frightening. That's about 10% of the U.S. GDP. Trump's plan was to grow out of debt. So his idea was to borrow, but then to grow the economy and not grow the debt, so that the debt became a lower percentage of the overall economy. Let's call it 100% now. Japan at 280% at the highest ratio is the most constrained. But of course, COVID put a dent in Trump's plans, and Biden doesn't seem to, he hasn't really articulated plans on how to get out of debt. He's only said he wants to spend money. And if you spend money and don't have options for getting out, you limit your ability, you tie your hands. So I'm concerned that this additional stimulus could be a short-term, call it a sugar rush for the U.S. economy, and it could wear off in 6 months, and then you could have the, even sooner, you could have the economy come back down. So I think this 1.9 trillion, if it's designed to allow low-income people to spend money, then some arguments for that will go into, Goldman Sachs in particular would argue that that's going to boost commodity prices. You get a pump up through April, and then it could fall away. So will the stimulus create sustainable growth, or will it be a sugar high and we'll be saddled with the debt? And I think that's a concern. This chart here shows risk. There's a bell curve around the earnings estimates for any company, and then that extends to a group of companies or the overall market. And the blue line here shows where there's less uncertainty, and you would therefore have higher prices. The green line shows a lot of uncertainty, where you'd have a lower price-earnings ratio. And the classic example I give there is Procter & Gamble has a very narrow range in earnings estimates, and it has a high price-earnings ratio. You pay more for predictable earnings than for an auto company, where the standard deviation around the bell curve is very wide and the price-earnings ratio is very low. So risk is the other thing that moves markets. Liquidity, finally, is that a question? More liquid stocks are worth more than illiquid stocks. Apple's worth more than a company that's unlisted because you can get in and out. But on the top down, you'd say that capital markets were frozen in 2008. So the Fed bought liquid assets, giving banks liquid assets to increase lending and keep things flowing. And so what quantitative easing does is the Fed, let's distinguish here between the Treasury and the Fed. The Treasury would borrow money by issuing bonds, and it would spend that money in a $1 trillion fiscal plan. Monetary policy of the Federal Reserve Bank is owned by the banks, but it's not allowed to make a profit. If it makes a profit, it has to give it to the Treasury. But the point is that the Fed prints money. So what it can do is it can decide that it's going to buy $1 trillion worth of bonds from banks, then it holds those, and those mature, and eventually it gets paid back on the horizon of the investments that it makes. And what happened in 2008 is they bought stuff at discounts in the open market, and it matured, and they didn't lose any money. And the same idea is now. What we see here is the liquidity of the, well, maybe Steve, do you want to talk to this graph a little bit?
Yeah, so what we've seen in the last year, really, during this COVID period is the balance sheet of the Fed expanding by approximately $3 trillion. So it essentially doubled from the end of 2019 to where we are today. And that is reflective of the Fed's extremely accommodative policies in quantitative easing. They are buying back approximately $120 billion per month in bonds, and so that is flooding the world and the US in excess liquidity, which is extremely supportive for asset prices. So if you look at equities compared, well, on a relative basis to other asset classes like fixed income bonds and real estate, equities still look like pretty good value, considering that we've seen an increase in the earnings of S&P 500 companies from the fourth quarter of 2019. So in this last fourth quarter results, we've seen earnings rise by about 3.5% from the fourth quarter of 2019, which was coming off of a pretty high base. So we've returned to pre-COVID earnings levels in the fourth quarter. And that is going to drive GDP growth this year. Goldman Sachs has a 6.7% GDP growth forecast for 2021, and that ultimately will continue to drive earnings. But if you just look at this chart, we see that the Fed balance sheet really started expanding post the GFC, and that was the beginning of aggressive quantitative easing policies. And they began to start paying that down in, call it 2014, and COVID changed things significantly. So it'll take a long time for that balance sheet to come back down to the 2019 levels. And in the meantime, we've got a lot of liquidity in the world that needs to be eventually mopped up.
Thanks, Keith. So liquidity will push values up. And the relative value model graph here, you can see in the bottom left-hand corner, oil has very low margins. So those earnings could go up. They already have liquidity. Pharmaceuticals have a low PE because there's risk around the horizon over when drugs might mature. So they have a low PE on their risk profile on getting drugs extended on patents, et cetera. Whereas the FANGs are trading at a very high valuation because they've got higher growth rates. So they're trading at a higher price earnings ratio. Lodging, to me, looks radically overvalued compared to oil, where oil is going to be around and lodging is highly leveraged. So I think there's a mispricing on lodging there. We wouldn't buy lodging in restaurants right now. And the lodging in restaurants, by the way, part of that is driven by Chipotle, which is doing very well in some other food restaurants. That's lodging restaurants. So my concerns are that during the global financial crisis, the government blamed banks. And I don't think that the banks were the ones to blame. I think the US government was to blame because they were running this trade deficit as a policy. So if you export US dollars and import widgets or broomsticks or whatever you're importing, the OPEC and the Chinese export, China is the biggest lender around the world, right? So they lend money to the US, they buy US government bonds, and they sell goods to US consumers and accumulate US dollars and then invest back into the United States. That money, that flow of $500 billion a year causes asset bubbles. And so we had a housing bubble, and I think that was caused by the US government. That has not gone away. Trump wanted to try to solve some of the trade deficit problem by having a trade war, and he didn't get there because COVID sidetracked everything that he was trying to do. But the problem with the trade deficit exists. And I would say that the problem now is that quantitative easing is masking this ongoing problem of exporting US dollars and having that money flow back into US treasuries, causing a US deficit. One of the issues, and I'll go to the bottom line here, is it says liquidity benefits the rich. And there's a K-curve recovery. What that means is that rich are getting richer and poor are getting poorer. So a K-curve means richer, richer, poorer, poorer, and that continues to happen. This stimulus of 1.9 billion could cause a sugar rush for the poor and an increase in commodity prices, but it may not last. And it may just and according to Thomas Lee, may cause a fall in the market in April. He's bullish now, but he says when the sugar rush is over, there could be some concerns. The big bulls on the street, JP Morgan, Fundstrat Thomas Lee, who was ex-JP Morgan, and Goldman Sachs, who we got a lot of respect for. That Costin just seems to get it right. He's very consistent with his last report. The bears, Savita Subramanian at Merrill Lynch, is very bearish on the market, concerned about potential tax hikes. Citigroup Tobias Levkovich, again, very bearish on the market, and Wells Fargo, RV, very bearish on the market. Morgan Stanley is also bearish on the market. On the bull side, Dubravko Lakos is saying that he's expecting a nirvana next year as risks fall. There's no more trade war, COVID is going away, the election uncertainty is gone, and he doesn't see a lot of risks in the market. I see a risk that corporate taxes could go up. So I think he's missing something there. He's saying US corporations are holding $2 trillion in cash. And one of the things we wrote about was called the Virtuous Cycle. And the Virtuous Cycle says that companies will borrow and they will spend the cash to buy equity. And so now we've got $2 trillion in cash in US companies' balance sheets, and they will do buybacks and they will do M&A. There's missing an A there. There's some micro tremors in the energy crisis in Texas, but that's not going to be a headwind. Yellen's slogan is "Go big," and inflation is not a problem. So JP Morgan is saying, "Don't worry about inflation." We agree. He says that the core CPI is about 2%, and that for it to go above that for the last 30 years is pretty rare. And one of the reasons we don't have inflation is that technology is advancing to digitize and create efficiencies and keep prices down. Do we have a question? No. The consumer recovery is going to be the dominant theme. There's going to be a reopening. There's $30 billion in stimulus, plus another 2 in stimulus from the U.S. There's a wealth effect. There's healthy consumer balance sheets. There's a healing labor market, so jobs are going back up. Fast-growing millennium spending, but if you want to hedge against that, you'd own some commodities, some oil, some agriculture, and emerging market foreign exchange companies, commodities like Brazil. David Cost, in his argument, expect the market to go up 10% this year. He's saying that we've done the V-shaped recovery for earnings. Earnings went down during COVID, they recovered in 4Q, and earnings are where they were in 19. Now, it's a different mix. And I don't think he's emphasizing enough that it's a different mix. The profits are coming from extraordinary gains out of the FANGs, but he's saying there'll be a lot of catch up from other industries, such as energy, semiconductors, computer hardware, pharmaceuticals. A lot of these other industries are going to catch up, and that's going to boost earnings beyond 19 levels to higher levels in 21, and the market will go higher on that. Now, as I said, I think there's some concern that you have extraordinary level of profit for the big tech, and that could come under some headwinds. But he says the risks are taxes. The other thing everybody's watching now is Israel. Of course, they've vaccinated more than half the population, and it's a wait and see to how that's going to take hold from the spreading of the virus. So Israel is the goldfish bowl at the moment for watching on the effectiveness of the vaccines. But he says the other risk is that Biden will raise taxes. But that's U.S., so half of the earnings come from the U.S., half from overseas, so only half of those earnings will be taxed at the higher rate. There's no concern about inflation. I'm concerned that the $1.9 trillion is a sugar high, and that it'll have to be paid back, and I can't see how you grow out of that. You got to grow the economy 10% to grow out of that debt, or you've got to raise taxes to pay it back, and corporations can't pay that tax. It's got to be individuals. So his stay-at-home stocks, Facebook, Amazon, Netflix, Microsoft, Google, Zoom, et cetera, we're all down this month on a raise in interest rates, and I think that's a mistake for them to react to interest rates. Thomas Lee, someone want to do Thomas Lee to hear a different voice? Andrew, do you want to do Thomas Lee? No? You want to talk about a stock? Well, let me skip Thomas Lee, because how's the timing going? Yeah, I'm going to skip that one. Bears, Savita Subramanian is saying that the stimulus will support income equalization. In other words, poor people will have more money, but she's saying sell big FANGs, buy cyclicals. So the FANGs are overdone, sell them, buy cyclicals, that'll drag the overall market down. The risk is inflation. If we get commodity prices going up, you have inflation, you have interest rates going up, and you have a headwind for the cyclicals. So get out of the FANGs, own the cyclicals, look out for taxes, look out for inflation, right? Tobias Levkovich says we're looking for a 10 to 20% pullback, not a 50% collapse, and he's looking for the market to be lower by the end of the year. The Biden stimulus will go to homes. So people are going to buy houses, they're going to buy white goods, they're going to buy cars. That's going to drive cyclicals, and the valuations are extended in software and services. Harvey goes further at Wells Fargo. He says that Tesla is like AOL 20 years ago, and I want to put a stop to that garbage from him. In 1999, we had the new economy, which allowed for above average growth of, say, 5% without inflation, because we had technology and digitization and the internet allowing for more efficiency, more productivity, which would allow for higher growth without inflation. So they increased the speed limit on the economy, and as they increased the speed limit, they increased the valuations to 25 times earnings. Okay. Now, that's not what's going on here. Tesla is not comparable to AOL. Okay, it's just not a reasonable comparable. Maybe he wasn't around then. I know I looked like I was. So I'm going to put a bullet in his argument because I don't think it makes any sense. You can't compare Tesla and AOL. Now let you guys talk about some stocks, and I'll let you take over from here because we've got about 15 minutes to go, and I think I rushed through the last bear analysis, but you guys obviously can call me anytime and we'll go through the details.
Thank you, Joe. So just some updates on the stocks comprising the relative value portfolio. Goldman Sachs, they have described the work from home era as an aberration and not the new normal, but they certainly benefited from the crisis. They managed 22% revenue growth and 36% profit growth for 2020. A fantastic result. Trading at 10 times forecasted earnings, and we're seeing some nice expansion in the price to book value and net asset value multiple, now trading at a healthy premium, 1.4 times.
I have a question, Chris.
Joe.
Their head lawyer quit yesterday, and they had another very senior manager leave the day before. And have you had a look at these people, and is that risk to the stock?
Yeah, my first thought was, after years of the stock languishing, maybe some of these executives are happy to cash out. Some of them are pursuing opportunities at fintechs. Tiger Global, an asset management firm, has, I don't know whether they've poached, but they've hired the co-head of the asset management division, and Walmart, with their nascent fintech business, have poached two of the Goldman consumer banking division heads. So there's been a few senior management changes.
The blockchain hadn't left. So
I didn't see that one.
Well, it was a little while ago, but my contact's gone.
Yeah, so some management changes we're aware of. I haven't read too much into it just yet.
The stock's on fire because of the interest rates going up and increasing interest rate spreads and their Marcus product.
Yeah, the consumer bank has now attracted $100 billion in assets. Coca-Cola, it's about $50 a share, still $10 below the pre-pandemic level. It's very much a reflation investment thesis, and a bit curious that they haven't participated like a lot of other reflation stocks or sectors in the rally. So there's about 20% upside there on the stock price, in addition to the 3.3% dividend. Perhaps we can attribute some of the weakness to the adverse tax ruling. They continue to fight against the IRS, disputing the tax they owe, and it centres around their transfer pricing, dealing with foreign subsidiaries, but also perhaps the warning on costs that Anheuser-Busch may have weighed on Coca-Cola.
Talk about your reflation trade. Since I just want to point everyone's attention to that left chart there. Since March 18th of last year, the stock is up 580%. 580%. It's gone from 3.5 times earnings to 16 times forward estimates, and that's driven by, I think, more certainty at the corporate level. Shari Redstone, Sumner's daughter, has taken over. They are the controlling shareholders, controlling about 80% of the voting stock, and so there's a clear hierarchy now in the firm, and they're focused on rolling out their streaming service, and they have a huge amount of content that they can stream from their Paramount studio book of past movies and television shows. They just have a tremendous amount of content, which gives them an advantage over Netflix, which is producing new content. While Viacom intends on spending $5 billion per year on their streaming service, they have a deep well of content that they can draw on immediately when they launch tomorrow. On Thursday, they'll be launching the Paramount Plus streaming service, starting at $5 per month, which I think is pretty reasonable. You compare that to Disney Plus, which I think charges $14.99 per month. So they are competing on price, I think, to get initial subscribers. But I will be subscribing because one of the new content that they're producing is a revamp of Frasier.
Is that, you gotta sign up for a month? I mean, for a year or what?
I don't know. I think,
mean, but $5 is like, they're giving it away for free. They're really collecting data on the consumer more than they are charging you for the content, right?
yeah, I think they're trying to build a subscriber base. Disney Plus launched in November of 2019, and they now have over 200 million subscribers. It's just been an enormous success. Now, will Viacom follow that success? I think to a certain extent, but perhaps not. You know,
Will the Australian government block us from accessing it here?
oh, I'm sure that there will be licensing arrangements made with local media.
So it's $5 for a U.S. citizen, but Australia might
That's
have a different deal.
That's right. So maybe it'll be $10 Australian dollars per month here in Australia. There's also this notion that Viacom and CBS in particular will benefit from the reopening of society with their live sporting events and live news broadcasts. But it's trading at 16 times earnings. About 20% of the float of the outstanding shares are shorted, which could be one of the drivers of this 20% rise in the share price we saw in the last 3 weeks. It's $69 per share, the highest it's been in a couple of years.
Well, it was up again last night, right, Steve?
Yep, up a couple bucks last night.
3%. Yeah.
I'll hand it to Chris to talk about Electronic Arts.
Thanks, Dave. Electronic Arts was a beneficiary of the stay-at-home and online gaming, but even before that, they had a number of new game releases which coincided with new consoles, the likes of Xbox and PlayStation. So a number of catalysts have now come to pass, and we would seriously consider divesting at around $150 per share level. It's about 10% higher than the current price. Viatris, which is represents the new combined Mylan and Upjohn, which was an off-patent division of Pfizer, reported earnings outside of the regular earnings cycle. And it was the guidance for 2021, which can broadly be described as a trough year, which disappointed on a revenue and EBITDA and cash flow basis. So I think this is very reminiscent of the experience with Viacom CBS, where the initial catalyst has been a merger, a corporate action, and now management need to execute and deliver to the various aspects of the rationale for that merger. And it's something that's referred to in the industry as a show me sort of story. There's been a strategy that's outlined. Now show me that you can deliver, and the stock price will be rewarded. The stock is really trading like it's going out of business. 4 times forecasted earnings. I mean, all the metrics there really highlight that. They're very much an outlier. And so they were the significant negative contributor to the RV performance in the month. Medtronic also reported earnings, I think, just after the last seminar. And they had a result that in most aspects, I would say, met expectations. It was a little bit of a surprise to see that the rising COVID cases sort of had a cumulative effect on hospital capacity through November and December, and impacted Medtronic's ability hospitals' ability to perform elective surgeries. But a very promising aspect in the result was the record sales of capital equipment, things like imaging and catheter guidance, which is very much an indicator of future demand. So the outlook is great, and Medtronic's got a terrific balance sheet, which has seen them through the pandemic and seen them raise their dividend through the pandemic. So it's a very high quality, solid business, and they'll capitalise on that backlog of elective procedures as hospitals reopen. Amgen's the latest addition to the model portfolio, or re-addition. We very fortuitously divested about 5 weeks ago, and the stock promptly retraced about 13%, coming into good value territory again. I suppose it speaks to the vagaries of the market in the short term. There really was no catalyst or fundamental reason for the stock to perform initially or recede subsequently. So we're buyers at this level.
Well, I disagree, because it went up because it was undervalued, and we picked that. The recent fall, I think, cannot be explained, but I think it's got a good reason to go up from here at 12 times earnings of a 33% yield, dividend yield. It's just really good value. So.
All right, I'll hand to Steve.
Alphabet. Not a lot of news. It's trading at 22 times earnings, which seems like pretty good value given their 25% revenue growth rate. The big news was this Australian media law, which passed, but it's watered down. Interestingly, Alphabet or Google threatened to pull their search services in Australia if this law passed. But in anticipation of it, they started cutting deals with the media outlets themselves. So part of the law gives Alphabet and Facebook time to cut these sort of unilateral content payment deals. But as Joe mentioned, Facebook won the day against the Scott Morrison government, is how it looks to us. But this will have worldwide implications for both businesses, but they could probably nip it in the bud by doing these, again, unilateral agreements with news sources worldwide. Things fell for the month, but Alphabet fell the least. It's trading just under 2,100. The consensus target price is 2,450. So we see about 18% upside from here. Qualcomm fell on this global semiconductor shortage, which is affecting handset manufacturers. They've had to push out production on handsets. However, we think that this is short-sighted by the market in that the 5G rollout is underway. And in the second half of 2021, with a pickup of handset manufacturing, the expectation is that 570 million 5G capable handsets would be sold this year. And the primary beneficiary of that is going to be Qualcomm. They make about 50% more on 5G phones than they do on 4G capable phones. So this will be a boon for them for some years to come. Trading at a very reasonable 17 times earnings. Andrew, would you like to add anything to Qualcomm?
Well, I think just to say that the technology around spectrum and where Qualcomm have found a sweet spot is a technology called millimeter wave, and it's another technology, disruptive technology addition to what we're seeing with the different bands of spectrum. And I think this plays into what Steve was saying about this uplift, this 1.5 times uplift in terms of the average selling price of a 5G chipset. It looks like the Asian supply chain channel checks are indicating a lot more handset manufacturers are designing millimeter wave specific chips, or phones, I should say, to support the chips that Qualcomm are producing. So the channel checks look pretty good. Demand is really robust and strong. It's outstripping supply. And the earnings growth on Qualcomm is, we're looking at 70 to 90% earning growth. So the R&D investments, they're really starting to harvest that, and the return on those investments are paying off. So it structurally looks really strong, good valuation, as Steve said, and we like the stock here still.
Double down.
And that completes the presentation. We're proud of our long-term track record. Here are the current constituent holdings in the relative value portfolio, 9 with cash. 10% cash weighting, and then of course we have 2 Chinese supplemental holdings to Baidu and Alibaba. Happy to stick around for questions.
And a good outperformance recently. It's good. Nice beats.
Yes.
Thank you, Steve. A replay of today's webcast will be made available shortly after the presentation and will be emailed to you. Anyone with additional questions can contact myself or the team, either via email or telephone per our contact details on the website. And that does conclude today's webcast. Thank you everyone for joining us and your time. Stay safe, everybody, and we look forward to speaking with you soon. You may now disconnect.
Thanks, everyone.